Chuck, you stole my whole intro. That's basically all I wrote there for this whole thing. Yeah, thanks. But yeah, Chuck got it right. I'm Stephen Chakota, the Executive Director for the Parkland Chamber of Commerce. We're operating in Dauphin and servicing the area out there for all the businesses in that region. And currently the chair for the Chamber Executives of Manitoba. And yesterday we got to host our conference in AGM, just in another room here. And it's great to be back hosting events like that and bringing everybody together for those learning opportunities and meeting the new faces that are a part of the team and getting back together with the experienced executives that we have in our province. So that was fantastic. And then coming to this event and being a part of this session here with everybody that has been in the room and all of Manitoba on the other end, watching today or watching as a recording. And thanks for joining here, and congratulations and thanks to the team at Manitoba Chamber of Commerce for putting this on, and thanks to Chuck for coming out here today, being a part of it too. Probably had nothing to do with any of this event at all, right? Zero. Yeah, just the face. So this is the Stephen Squared section of the agenda. I'm thankful to be a part of this and introduce Stephen Tapp. Stephen Tapp is the Chief Economist at the Canadian Chamber of Commerce. In this role, he is a key member of the Chamber's executive leadership team responsible for the operations of the new business data lab, as well as the economic analysis and research. His current focus is on developing the Chamber's data and analytics capabilities to provide real-time, forward-looking insights for Canadian businesses of all sizes in all sectors and regions in the country. Stephen brings 20 years of diverse experience at many of Canada's top economic organizations, including at Export Development Canada as the Deputy Chief Economist, the Bank of Canada, Parliamentary Budget Office, Finance Canada, two think tanks, and as well as academia. He is recognized thought leader, frequent commentator, and sought out spokesperson on economic issues in Canada. Stephen's research was awarded the Purvis Prize for Canadian Economic Policy and has been published in academic journals such as the Canadian Journal of Economics and Canadian Public Policy. He has a PhD and MA in economics from Queen's University and an honors BA from Western. During his undergrad, he studied in the Netherlands and was the owner-operator of a student painting company. So with that, the Stephen we've all been looking forward to seeing today, Stephen Tapp.
Okay, well, thank you very much, Stephen. Appreciate the introduction from Stephen. I'm assuming that everybody can see my slides here and that everybody can hear me okay. Looking forward to being there in person coming soon as we get back to in-person events. It's good to see people out and about today. What I'm going to talk about today, we couldn't have an economic summit without a discussion from an economist, I suppose. So the title for my talk today will be Shocks on Shocks. And just want to make sure that you can see the screen okay. So yeah, we're good. Can I get a signal?
You're going to have to share again.
Oh, okay. Apologies. Can you see my screen at this point?
All good.
And you can see the screen that's got slides as opposed to the other screen that's got emails?
Yep, that's right.
Great, good stuff. Okay, and so yeah, shocks on shocks is kind of what I want to talk about today. So we had obviously the big first shock from the pandemic, the rebound and reopening phase, and a lot of people in the business press were talking about this roaring 20s, referring to the 1920s. Obviously, the 2020s might be like the 1920s in the sense of strong growth, but eventually a crash that they had in the Great Depression. And then more recently, with the outbreak of war in Europe and increases in inflation, the discussion has turned to comparisons more like, was this the 1970s and the period where we had inflationary pressures and slowing growth. So I'm going to talk a bit about those issues, the pandemic shock, the shocking inflation that we've had, the war shock, and really I'm going to echo a lot of what has been said earlier in the sessions today in terms of what are the key things that Canadian businesses and businesses in Manitoba are telling us that they're worried about, their big pain points. Those three things here we'll talk about today. Cost pressures, so related to the increase in inflation, supply chain disruptions, and labor markets that are extremely tight and very difficult to recruit and hire workers, which we had sessions on almost all these earlier in the day. So I'm going to go through some of these same issues, but I'll be showing lots more charts and lines going up and down. Let me start with the pandemic. Of course, everybody knows and has lived through this over the past couple of years. We started tracking data looking initially at COVID infection rates, and then looking at hospitalizations. There's data on deaths, sewage, wastewater, and other things that people have been looking at. This chart here shows the global estimates looking at deaths that are officially related to COVID. There in gray at the bottom part, about 6 million at this point in time now that have been officially attributed to COVID, but there's obviously more estimates of excess deaths, which look at the number of overall deaths there have been in a particular period when there wasn't COVID relative to the COVID period of time, and confidence intervals around that. But basically what you see is the waves. And of course, we had a big wave back at the start of this year in January, and we're coming off of that. And hopefully not back to normal yet. I'm in the office. There's a couple other people still in the office, but things in the downtown Ottawa are picking up, but certainly not like they were before COVID. So how's the economy done? Well, I would say Canada's economy in general has done a lot better than people had expected over this point in time. There was on the chart here on GDP shows there was about a 15% decline as the lockdowns went in place at the start of 2020. A very rapid recovery, and then you see this upward sloping kind of growth trajectory line that happened, punctuated a little bit by some lockdowns that came on and off at different points in time, and the absence of a reduction really in the January data in 2022, which was surprising to most because we thought the Omicron wave would be difficult. There were a lot of job losses in January, but actually output GDP has done quite well. So all that to say, we've recovered back to the level of output, surpassed the level of pre-COVID output on output GDP measures. When you look at labor markets are extremely tight, as was mentioned earlier, and I'll show some other charts on this, but the unemployment rate was looking at the labor force survey data that was released today at 8:30 in the morning. It had moved down from 5.3 to now 5.2. So that's the lowest level it has been since they started doing the survey on a monthly basis back in '76. So labor markets are tight, output has been going up. And of course, was also mentioned that there's been a lot of differentiation when you look across sectors. So the changes in employment during the pandemic, about an increase of 15% for those in professional services. Public administration obviously has been up, finance and insurance. So those more higher tech uses of IT, work that can be done remotely, that has taken off in the pandemic. And if you look more on the bottom of the red side, there have been reductions of employment about 15% or more for accommodation and food service, as we had discussed earlier. Travel, tourism, restaurants, all those have been hit extremely hard. Agriculture down, given difficulties with bringing immigration in, but also the droughts and very tough conditions we've had for crop production over the last year or so. So that's just a lot of differentiation there, and it's hit low wage workers more than higher wage workers. Now, the big shock for economists, I would say, and for central banks has been what's happened to consumer price inflation or overall price pressures in the economy. We have this combination of very strong demand. So consumers had been stuck at home. They had often had support programs and savings that accumulated because they were not spending on in-person services. Position that towards goods, and so you saw a lot of demand for space, housing increased, purchases of cars and the like. So there's very strong demand for goods, a lot of constraints on supply. So supply is hampered, but demand is strong. And what that means is we've had inflation and higher inflation. You see the top of the band there is 3% for the Bank of Canada, but their average, they looked to average about 2%. And so we've been above the top of the Bank of Canada's band for at least a year at this point now. And with almost each and every data release, inflation has been higher than most expected and higher than the central bank has expected as well. So we have an inflation problem right now, clearly. Let's go to the business obstacles. I mentioned those three big things we'll talk about today, but let me start to just show you some results from the StatsCan survey on business conditions, which we helped to run with StatsCan, and the Business Data Lab at the Canadian Chamber has been inputting, helping to design survey questions and develop the survey from the start of the pandemic. So this has helped us really track in closer to real time what's happening on the ground. And these are questions about what business obstacles are expected by companies in the coming quarter. And you see the top ones there. So in orange is costs, about 37%, labor, about 37% of companies. And in teal is supply chain. All those lines are upward sloping. And so for the last year, all those problems have gotten worse for companies. And you see a bit of the rotation. Consumer demand there is number 4, and consumer demand was number 2 about a year ago. So weak demand was a problem earlier in the pandemic, in the middle of the pandemic, but demand is not a problem now. Supply is obviously the problem that we have right now. And as I mentioned, that's resulted in inflation, and firms are feeling that inflation. Cost pressures here are not only rising, but they're broadening across a wider range. So if you look in the consumer price index, of course, food and energy prices have increased a lot, and they've increased even more since the war broke out in Russia and the Ukraine. But in terms of business costs, there we've got 50% of companies now saying that in the next 3 months, rising input costs will be a problem for them. So that's the highest number we've had on record, and you can see those numbers have increased over time. And it's not just broader input costs, but it's more disaggregated and detailed. Costs of insurance have gone up for about over a third of companies, transportation costs associated with supply chain bottlenecks, and pandemic-related issues. So the cost of PPE or different types of restrictions and measures that require social distancing has increased costs for companies. So costs have increased quite significantly for companies. Not surprising, but it's, again, higher and it's broader than it was earlier in the pandemic. This chart is a little bit busy, I'm sure, on a big screen for everybody, but what I wanted to show here is just the correlation or association we have between the cost pressures for businesses. So if you move along the x-axis further to the right, are companies that more businesses are thinking that input costs will be a problem for them the next quarter. And on the vertical axis, kind of moving higher up, are pass-through. So we asked specifically for companies how likely they are to pass the increased costs they have on to customers in the form of higher prices. And I'll just circle to make it a little bit easier for you on this chart. You see that positive correlation, but where price pressures are highest, they're going to be moving in those areas. So obviously people know in accommodation, food service, price pressures are very high right now. In manufacturing associated with supply chains, construction from the very, what's been a very robust housing market, which may start to slow as interest rates go up. And on the retail side. So those are some of the sectors. I mean, obviously the others are showing similar patterns, but the areas where the biggest tightness and biggest problems are in those 5 sectors. Now let's talk a little bit about the competition for talent, because this was mentioned earlier about labor market issues. It is true that firms want to hire. However, like I said in the top of the chart here, they're having a very hard time attracting workers and retaining workers. So the left chart here is looking at job vacancies. This number broached 1 million at a little bit early in the fall of last year. 1 million job vacancies at that point in time. So firms looking to hire workers. At the same time, we had well over 1 million unemployed individuals that were looking for work. And so people were sort of wondering what's happening in the labor market and why are there so many people looking to fill jobs and so many people looking for jobs, but we're not seeing a lot of the job gains. And that has really sorted itself out, I would say, over the last 6 months or so. Job vacancies have come down, although they're still very elevated, over 826,000 job vacancies right now in the latest data. So there's lots of jobs. If you're looking for work, it's a good time to be looking for work. If you're trying to hire, it's not the best time to be trying to hire. And those are the same results that you see here, only for recruitment, which is a bit higher. So I'm recruiting right now for folks at the Business Data Lab, and I can tell you as well that recruiting has been a challenge for us, sifting through the applications and trying to get people with the right skills at the right price point. So the retaining employees as well. The mass exodus of workers that's been happening more so as South Side in the United States hasn't really happened to the same extent in Canada, but getting people back has been trickier, and there's going to be adjustments happening on flexibility and the like. So let me just show that question for business plans. What are businesses doing right now if they're struggling to hire? Companies are doing multiple things, but the top line here is that they're paying higher wages. So there are pressure on wages. We're seeing that increase over time. Inflation is very high, so workers are saying, if inflation is running at close to 7%, I'm going to need more than my usual inflation, 2% or so nominal wage increase to make up for that. They're paying more, prices at the pump, and et cetera. So people see that. It's very visible right now to workers. It doesn't really matter if inflation's 2 or 2.2% to most people, but when you see inflation this high in the headlines, and up in your face when you're shopping. It's a bit more salient to people. So that's one thing on wage pressure. So we see 45% of firms saying that for existing workers, they're going to have to increase wages to attract new workers. The same kind of story. The other color there that you see in third ranking is flexibility. So there's a couple of things on flexibility for scheduling or a lot more remote work, and maybe hybrid scenarios that are being considered. And so work will be more flexible and will likely be higher paid over the year ahead, depending again on what sector you're in. We're also even seeing some places, some sectors where signing bonuses and things like that are happening to try to attract workers. So it's certainly a dire situation for some companies. Let me talk about supply chain challenges just briefly to illustrate some pictures and some charts on that as well. This is a shot from a satellite on NASA. So I'm not normally on NASA's website, but when supply chain challenges got to be a big issue last summer in the United States off the west coast of Long Beach and Los Angeles, you could see if you squint and look very closely, depending upon how big the screen is for you folks there, there's a big lineup of vessels waiting to unload their cargo. There were huge backlogs. President Biden had to step in and work to try to negotiate with longshoremen associations, unions, and others to work through those backlogs. And so over last fall, there were improvements in what the situations were like in the United States for their supply chain issues. But now on the right hand map here, you see this is something taken from data just yesterday in Shanghai port. So the COVID zero policies that the government in China are implementing to try to stamp out and make sure that there's not a massive spread among huge populations and big land masses there with 25 million people or so shut in for over a month with lockdowns that are pretty severe. That's limited the ability of workers. It's also caused massive backlogs where by some estimates now about 20% of the global fleet is not moving, is not in transit, but it's simply waiting to unload cargo or stuck with backlogs. So normally ships would be a couple days in and out of the harbor, and now in China it's over a week. And back in the States, we had things were probably up to a couple weeks, which is basically through a global supply chain, we have one problem in one part of the system and it spirals through the rest. And so that's where we are right now, the COVID zero policies. So even though COVID in the Western hemisphere and the North has been improving, COVID has been more aggressively fought in China, and that's going to have problems for supply chains going forward. So this index here on the left is an estimate from the New York Federal Reserve, which brings together a lot of different measures of supply chains, of costs and time waiting to unload cargo and the rest of it. And just basically demonstrates that we saw through the COVID recession at the start, the massive increase. There were some improvements last year, and then kind of like inflation, kind of like the supply chain issues we had, things got progressively worse and worse. And we're now at things that may have peaked, although this was before some of the more recent data in China, but we're still at a really elevated level. And so there's very severe and significant supply chain pressures across the globe. When you turn to what that means for Canada, these are Canadian supplier delivery times, and these are questions that are asked by Ivy to different purchasing managers in terms of how long it takes to deliver products in Canada. Anything below 50 means a worsening of conditions or lengthening of delivery times. And so you see the big drop there down at the start of the pandemic, and then things progressively getting worse. The circle I put on there shows that as we had the global challenges and things were starting to get a little bit better for the US, we actually had the floods out in November, December in BC, and then we had protests at Ambassador Bridge and other places. So obviously, it's been a difficult situation, and this is basically what I meant when I said shocks on top of shocks. So the BC floods are making things worse, the protests are making things worse, and we're still at a point where supplier delivery times are pretty extended. This is a map which just gives you a better sense regionally of what's happening in different parts of the economy. So the top headline here is that about half of companies in both the prairies and in Ontario, when they were asked in the first quarter what they thought would happen in the next quarter, that's the blue expectations for the next 3 months. Will things get worse? About half, 48% in the prairies, 47% in Ontario said things get worse. So of course we had worsening conditions at the end of last year and in the start of this year, but the more important question for us was really kind of looking ahead to say, what do people think is going to happen? And so like inflation, as I mentioned, supply chain challenges have dragged on, and that has caused inflation. So the big problems are really in central and kind of Western Canada. What are companies doing? Kind of what we asked about what companies were doing for labor market challenges. Well, they're doing a variety of things here. They're finding new suppliers, they're finding local suppliers, and they're trying to substitute in terms of their production processes to use different inputs than they were using before. So you see the numbers in terms of responses there for what companies will do in the year ahead, but it's around a third of companies looking for new suppliers than they had before, or making substitutions to their inputs. And also the reshoring that you see and you've heard of, looking for more local supplies, is about 18, well, about 1 in 5 companies are looking to shift and localize production processes to some extent to try to make their systems a bit more resilient to deal with shocks. When you look at the programs, there are a lot of government programs that started in the pandemic, and a lot are being wound down now, from wage support subsidies to debt relief and loans and other types of things. The question that was asked here was about businesses in terms of where they're at for debt levels and whether they can take on any more debt, which would be a constraint in the recovery phase. So about 1 in 4 companies said that they couldn't take on any more debt. They had hit the wall, they were at their limits. About another quarter, just basically unknown for them. And so about half of companies here are really struggling with debt issues, and that's going to cramp a little bit in terms of overall ability to invest on the hiring side as well. When wage pressures are going up, it's going to make it harder for companies to hire. And these numbers are worse if you look at the sectors we showed at the front, accommodation, food service, and personal services. Numbers are worse there. And they're looking for loan forgiveness from government programs and other things to try to make things easier in the year ahead. All the stuff I talked about before, most of the data is essentially taken before the last 6 weeks or so in some cases. And so this was really all happening before we had the war breaking out, Russia's invasion in the Ukraine. And that has been awful for the kind of humanitarian issues that you see here. And there's talks about movements of large numbers of people across Eastern Europe, and even immigrants coming into Canada to resettle and to get their life going again somewhere else. So it's bad, obviously, for those reasons, but it's also because Russia's been a big exporter of natural gas and oil and other commodities, a big producer in the Ukraine, and Russia also of corn and other food, cereals and things. Energy prices have spiked because of uncertainties of supply. There's an oil embargo now. The EU just decided that there'd be an oil embargo. Yesterday, they announced that to try to prevent Russian oil from coming in, and trying to substitute them more to other sources as quickly as possible. Thankfully, we passed the winter phase, and so there's not as much heating days, cooling days, and heating days that will be needed for increased energy use. But that's a big situation that, again, has made things worse. It's roiled financial markets. So obviously, if you are following stock portfolios or other things, equity markets are down quite significantly, not only because of the war, but because interest rates have been increasing as well. So let me turn now with that as the kind of high level backdrop. Let's talk a little bit about the outlook for businesses in Canada, and we'll talk about Manitoba as well. I'm keen to hear what people are hearing on the ground there. I charted here what I've called the muted recovery for Manitoba. So this is just my perspective from Ottawa, kind of looking at the data and seeing what we see. The left-hand chart is looking at annual GDP growth for Canada in the red bars and for Manitoba in the teal bars. And you can see that Manitoba's growth rate has actually lagged over the last, I'll say 3 or 4 years, has been weaker, considerably weaker last year than the national average. And again, this is related in part to some of the drought conditions for agriculture crop production, which has been hit quite hard, as well as others mentioned, difficulties with immigration in the ag sector, unemployment. So typically, at least what I had looked through before and been through other Manitoba conferences, it's often the case that Manitoba's story is less exciting than the national story because there's less volatility and less action, and normally with a more diversified employment mix and industrial composition, they don't get the highs that you get out in Alberta or Saskatchewan, and certainly don't get the lows. But at this point in time, we're seeing Manitoba struggling in terms of the overall data to keep up with the national trends. And the right-hand chart shows employment, where you see, this is updated from this morning. So overall employment has increased in Canada by 2.4% relative to the start of the pandemic. At the national level, BC is leading the charge. And if you look down, Manitoba moved from 9th to 10th place in terms of the overall provincial results. So Manitoba's employment is up, but it's up by less than half a percentage point relative to the pandemic. And so again, is lagging behind the other economies. Having said that, despite the fact that employment has not taken off to the same extent as other places, there are still very big issues, and Manitoba, in terms of measures of labor market tightness or difficulties that firms have hiring workers, is about the third tightest province in the country. So you see Manitoba there that I put in teal, compared to worse than the national average and a little bit better than Quebec and BC, but still pretty bad. And so I'm sure as companies can speak to this, we have a lot of job postings and not as many, well, basically more, almost one for one in terms of the number of job postings for unemployed people, which is a pretty elevated and high level at a typical point in time. So I'll just highlight a few things before I close my remarks and get to your questions. We have been tracking through the Business Data Lab. The Canadian Chamber has been working with StatsCan, and there are some different measures that are exploratory at this point in time that pull together traffic flows and other statistics that are available in real time that you can look at a weekly basis. So this is called a real-time local business conditions index. We're just kind of getting through the development phase to understand how these work, but the line I've shown here is for Winnipeg, and there are now 20 CMAs available in Canada, and so I show the range from the lowest to the highest, and you can see the movements there, mainly perhaps based on mobility movements coming down more recently for Winnipeg, but you see a slowdown there in the most recent data. So that's what's happening there. We'll obviously have more to say and be back as we develop some of those measures, but I'll show you one more here, where I've taken the Canadian Survey of Business Conditions from StatsCan. And what we've tried to do is use the CMA level data in this case to look at the questions that are for the next 3 months ahead. What do businesses expect for growth in terms of employment, for capital spending? What are they seeing happening for their profits and their sales outlook? And we're bringing those kind of together in an illustrative index. Anything above 50, which is shown in green there, is positive, which means things are expected to get better in these CMAs for the next quarter. So Winnipeg there is at 50.5, so that's not a huge showing and not all that strong, but the Canadian number is a little bit over 50, so kind of a little bit of very, very modest, I've called modest optimism there. So Winnipeg's number is modestly above the Canadian average, and you see slower expectations for Toronto, Vancouver, Edmonton, and Ottawa. And again, these are some data that we'll have more to say about as we get into the work on that. There's the breakdown there for the different categories. Profits are basically going to be slow given the pressures on costs, but investment and employment intentions are very strong and sales are quite high. To sum up here and conclude, so we can get to Chuck and get to the questions, firms are dealing with and coping with higher costs. So the inflation problem is a real problem, and this is impacting businesses. Costs are rising a lot. Labor markets are tight. It's hard to hire workers, and supply chains have been an issue as well. The combination of relatively robust demand and spending side alongside problems with supply has resulted, not surprisingly, in high inflation, but inflation has been surprisingly high, I think, and much worse than most economists thought. Central banks now, the Federal Reserve increased rates by 50 basis points this week. The Bank of Canada has moved twice in these oversized rate hike moves because they realize that they're behind the curve, that inflation is out there, and they need to get interest rates up quickly and tighten financial conditions to try to bring inflation expectations and inflation back under control. Russia's war has made things worse. It's hampering and slowing the global recovery. It's increasing energy and commodity prices. It's hurting food prices. There is a very real risk. Obviously, the economies in the Ukraine and in Russia are going to be devastated, but there's a very real risk in Eastern Europe and economies in Germany and Italy that are strongly tied to Russia. There's a potential for a Putin recession in Europe at this point in time. China's policies on COVID-0 have made things worse on supply chains, so it's a bit of a downer there for that. Talking and summing up what's happening in Canada, I would say our recovery has been pretty strong. It's been better than most economists expected. Manitoba, based on my read at some of the aggregate statistics, has not kept pace, But in general, firms are, I would say, modestly or cautiously optimistic about the quarter ahead. And with that, I will just leave my contact information here in case you want to get a hold of me after. But I see Chuck is back up at the podium, and I'm happy to pause there and to take any questions that you have for me. So thanks a lot for the opportunity.
Excellent. Thank you, Stephen, for the presentation in terms of providing that that overview of kind of what's going on. I'll be honest, when you look at that, you kind of get depressed, don't you? In terms of some of the challenges that businesses are dealing with, when you look at the labor challenges, when you look at the cost pressures and all of the different things that businesses are having to deal with as they're coming out of COVID, it seems to be this perfect storm of additional challenges. You know, when I look, and what's always interesting, and we've done these kind of surveys as well, is that I'm always interested in the optimism among the business community. And when we've done surveys, the business community always seems to have that level of optimism. Is that you know, you kind of showed that trend that shows about 50%. Is that where would that rank sort of pre-pandemic? You know, I'm interested in that.
Yeah, no, that's a good question. So we have been working on this survey, this particular survey with StatsCan only since the pandemic. So I'm now kind of going through the various waves and looking at whether we can do disaggregated metrics for different cities. And so that's kind of one of the first cuts at that. So I could have a better answer once we kind of put some reports and results together. But I would say relative to other surveys, like CFIB has surveys and others, Nick Nanos has a survey on the same types of questions for optimism. And in those areas, generally something in the higher 50s would be more normal. And that would be looking at growth, but looking at growth that's at in an economy, let's say, you know, growing around 2 or 3% overall. At this point in time, that 50 reading is pretty modest. Having said that, that's sentiment data, these are expectations. And when we look at the data that's been at least brought in by StatsCan on output and employment, the first quarter on trade and on overall output's been pretty good. And people thought it would be really bad because the pandemic had a lot of people sick in January, a lot more people were sick again in April in the employment data, but overall output has seemed to keep up. And there's a sense that people have that they really just want to kind of get on with their lives and get back to normal as best they can. And so spending patterns are still, you know, mobility is picking up and spending's there. So I would say going forward, there's a lot of bad news in terms of what's happened over the last couple of years, but I do think businesses are hopeful that this summer will be better, and you know, moving forward, this year will be better than last year, which would be better, worse than the year before was worse. So.
Stephen, obviously, you know, the Chamber Network being an advocacy organization and providing, you know, advice at both a local and a provincial and national level. I'm interested in terms of the role that the Canadian Chamber is playing and some of the advice that you're suggesting to the federal government dealing with, you know, workforce challenges, cost pressures that they're dealing with, supply chain. So what's sort of the message that you know, Perrin Beatty as president and CEO of the Chamber and yourself are giving to government in terms of what are some of the needs that businesses need kind of going forward to be able to address some of these challenges? Yeah,
well, I think probably Perrin and Mark Agnew, who's our SVP of policy, would be better suited to give you more on the in the weeds and practical kind of this is what we want on this measure for this legislation. But I would say that the more general position that the National Chamber has had looking through the federal budget and the pace of government spending before and kind of where we're at is really to see a much more serious focus on economic growth. The government has brought in a lot of programs and rightly brought in some social programs that were needed over this period in time, have been helping businesses through different measures. But I think one of those issues is, as I showed, the debt levels there. So it was nice and helpful to keep some businesses alive and throw them a lifeline, but not extending terms or forgiving some of the interest payments will be problematic for companies going forward. And just more generally with the government, we've seen essentially an inflation tax where GDP, nominal GDP, like the overall price base has gone up quite significantly. Government revenues are actually coming in a lot better than expected. And the worry is that the national government will end up spending more of those increased revenues and not allowing that to go to the bottom line and reducing deficits. So that's, I think Perrin would really be more concerned about having a real serious plan for national growth, because what we don't want to do is come out of the pandemic taking on significant debt levels for both businesses and for governments and not have a real serious way to pay for those things.
Stephen, are there specific sectors that, you know, in your data that are showing that are recovering quicker than others? I think you showed some of the data in terms of how well some industries are performing rather than others. Are there other ones that we need to continue to focus our efforts on to help in that recovery?
Yeah, I think I showed one chart at the start, but just looked at employment, but the output results and overall sales or anything else you want to measure, you do see it's been called a K-shaped recovery by some economists, which essentially meant that you had some sectors that took off, and those were in the high tech IT sectors, and they grew much more quickly. So professional services, finance and insurance, even education, the healthcare sector, even though they were hit by COVID, there was increase in demand for health. Those sectors have done well. Online retail, as opposed to bricks and mortar retail, those ones have obviously through this point in time, as people shifted spending patterns and adopted new, I know for my wife and I, we started picking up the groceries as opposed to going to the store, you do the drop off. And once people have learned those behaviors, that allows them to kind of continue to do those things. And so we've seen a shift in spending patterns and the way people buy things online. Amazon's obviously been one of the biggest beneficiaries, and other large retailers that are logistically inclined. On the flip side, you mentioned the places that we should be concerned about. We looked at debt levels. We asked those questions about debt. You look at employment. So I would say agriculture has been hit extremely hard. I was surprised to see just how bad the results were. So crop production in Manitoba was down over 25% in 2021, and it was worse in Saskatchewan. So things are relatively bad in the ag sector. And again, they're having trouble bringing in workers from abroad to help pick crops and do the rest of the work on the farm. So agriculture's been hit hard. We already talked about tourism. So I think you had seen a shift in tourism. People were traveling domestically because they were really more or less prevented from traveling outside. But now you've seen that pent up demand, and more people now will be going to the Floridas or Mexico or other places. And so it'll be very interesting to see what the tourism season is going to be like in Canada this summer, because as you know, it's been very difficult for a lot of those businesses to keep going. Any of the kind of personal services, things that had been done before, I don't know, let's say dentistry or massage or any type of thing that requires very close person-to-person contact, they had been dealing with restrictions that came off, that went on, increased costs and slowing down. I know at my barber, they used to cut, you get a 30-minute appointment, and now it's a 45-minute appointment. And what that means is the barber is going to cut less hair, and the costs haven't gone up by a 50% ratio to compensate for that. So it's been harder on obviously any of these high touch service sector places where they're open, but their sales have not recovered fully, and their costs have gone up, and so their profits are bad, and they are definitely at a point where their debt levels are high and they don't want to take on more debt. So I would say there's certainly a sector, probably 30% of the economy, possibly more businesses, so hundreds of thousands of businesses that are at a point where they're worse than they were before the pandemic. And they haven't really ridden the same wave that you've had from the IT side. So those are the places I think we should be worried about, and government policy should be focused on making sure they get back to a full recovery.
One of the things that I found interesting in your presentation as well, and we talk about this a lot, is obviously supply chain. It's been something that's been really raised the awareness over the course of the pandemic. But the picture that you showed from Shanghai in the harbor,
Yeah.
In terms of the number of ships, like 20% of ships in the world are all sitting in a harbor right now.
That is the estimate right now that I read this week. It says basically 1 in 5 ships is just sitting there waiting and is not productively moving and doing things, but it's just waiting in a queue to offload and upload cargo. Yeah, that's pretty startling.
So but based on that, and obviously you don't have a crystal ball to let it, to provide any kind of indication as to when something, but what kind of an impact could that potentially have, on the Canadian economy going forward if that solution and that issue isn't resolved, in the near future?
Well, the issue has morphed and changed. So as I mentioned before, initially it was the southern United States where there was a lot of imports coming in at the same time, and there were these massive backlogs in Long Beach and Los Angeles because China had recovered relatively. They locked down really quickly in 2020 in January and February, so they did a full lockdown, but they came back online quickly, and so the Chinese economy was back up and running. And there was slack in the trading system because we had closed everything down, and then demand came on very quickly. And so the kinks in the supply chain have essentially shifted to price pressures in one direction, other direction. You know, the United States, in Canada, we had on top of what was happening globally, we had our own, we had forest fires in one year, we had the drought, we had people protesting at the Ambassador Bridge, we had the BC floods. I mean, there's no limit to the number of things. So I would say if you go back in time, each successive survey that I had done at Export Development Canada, we asked questions on supply chains, and typically people would say, yeah, the next 3 to 6 months, we think that things will normalize. And if you kind of progressively move that yardstick forward every quarter, every 3 to 6 months, things had gotten pushed out. And so now the move in China I mean, they've had a zero COVID policy before, but they haven't had it in a place now where I mean, obviously there's massive populations, but in terms of the impact of the core shipping regions there, that's going to have huge impacts. You have the war happening at the same time. So there's just lots of issues happening. And what that means is the supply chain challenges are going to be longer. Energy prices are going to be increased. Food prices are going to be high. And that really puts central banks in a very bad position because inflation is high. They know they need to raise rates. They know inflation is, you know, we know we have a problem here, right? And what that needs is higher interest rates to slow demand. But it's not clear that they can calibrate that well because, as most people have said, changes in the interest rates are not going to unclog supply chains, and that's going to slow the economy. And so there really is a pretty tight balancing act right now that we are in the economy. And so, you know, going forward, things are bad on the supply chain side now. Of course, in the near and medium term, we hope that things will get better, but you've got a lot of things to work through that system, and it's going to take time. It's not something that can be done quickly.
Stephen, before we let you go, then maybe sort of one final comment. You've talked a lot about some of the challenges that businesses are having to deal with. What kind of a message would you send to, you know, small businesses here in Manitoba that are watching today about in terms of, you know, I guess a little bit into the future in terms of what to look forward to moving forward, and sort of how quickly it does kind of get back to you know, a little bit more normal, and you know, sort of we've entitled this this conference The Path Forward. So what is that path forward? What should small businesses be focused on here in Manitoba?
Yeah, so there is a path forward. I don't want to be all kind of down and dire and say that things are terrible. Things have gotten better, and things are getting better. I would say some of the key things that businesses will be aware of, we already mentioned, but on the labor market side, it's going to be tough to hire for the near term. So you've had other panels that would speak to challenges and ways you can address those challenges. I would say borrowing costs are expected to go up relatively rapidly because central banks are raising rates. So expect the cost of borrowing to go up. There's going to be a lot of challenges in terms of profitability. But on the flip side, we certainly do have a lot of demand from customers and people who are looking to get back out to restaurants, to patios, to doing things, to travel. And so hopefully if businesses have been able to hang on through this point in time, they can continue to move forward. And this summer and this year, we'll continue the improvements, and central banks can get us through, and the economy will be looking better. And when we come back, and I'm there in person, I guess if we have another conference again next year, we'll be in a much better state than we've been in at this point in time and looking forward. So still optimistic.
Stephen, thank you for your insight. Stephen Tapp is the Chief Economist for the Canadian Chamber of Commerce, joining us virtually from Ottawa. Thank you very much for your time today and your presentation to us.
Well, thanks so much for having me. I appreciate it.